spend some time, and I know this is a topic of very high interest to everybody, especially in the US. So I'm glad to be here, and inshallah we will all benefit from it. So moving on, Assalamu alaikum and welcome again. What you will walk away with today's presentation, the three objectives we have set forth are to confidence to start investing in US stocks the right way, a framework for choosing halal compliant investments, and tools to build a long-term wealth patiently and prudently. And the focus today will be, obviously we are all Muslims, alhamdulillah, is on the halal compliant investments. So making the money the right way. So why invest? The first question obviously comes into mind. Where should we invest in stocks? And a few days ago in one of the groups, a sister just sent me a message that you are doing investment. This is totally haram in Islam. Why are you doing it? And I had a hard time with her to convince her that at least she should go and ask some scholars what is haram and what is halal, rather than giving a blanket statement that everything is haram except for what she thinks is halal. So that she realized that she was taking very hard stance. But anyway, why invest? We have a few opportunities here. Most of us have full-time jobs or businesses, and we save some things for our future and future responsibilities like home, marriage, children, parents, Hajj, retirement, and all these things need long-term planning. On the other hand, the money, obviously, if you just put in cash, it's not going to do anything for you, especially when the inflation is on rise. And right now, as you know, the inflation is on again rise. It was around 6-7% a few years ago, and now again is into 3-4% bracket, and it is expected to further rise with all these wars and tensions and global conflicts whatsoever. So if you just put the cash somewhere, that's not going to help you. An old tradition and method of investment was investing in gold and commodities, and especially the household women, they used to put the gold and jewelry all the time under the beds and the closets and saving all those things. That worked. But the stock investment and the investment market, especially in US, are probably the best kind of investment vehicle, I would say, compared to any other mode of investment available. That includes real estate as well. Why? Because it's highly liquid. Real estate is not that liquid. You have to plan, you have to find a good location and invest your money for a while and then go through a process, whether you're buying or selling. On the other hand, stocks you can buy and sell immediately almost. With this electronic age is possible. And the compounding works slowly, so starting early matters more than starting big, and time is your biggest asset. So wealth is not built by saving alone, it's built by putting those savings to work. And especially, I was told that many young people's school-going and college-going children, they are interested in this topic, and we want to focus on them as well. We want to train them and let them know what is the best choice available for them. I will come back to this topic about the young generation investing in US stocks. So let's start with a stock. Almost this is nothing new, everyone knows, but just for the definition, a stock is partial ownership in a real business. So I had to explain to a number of people. Just last week I was in Baltimore in ICNA convention, and there one gentleman came and he was doing options trading, and he was seeking my opinion. I said that as far as I know, options are not allowed, and there are quite a few question marks around options being haram halal. So I will try to avoid this. I will not advise anyone. So he was having a long argument with me that why stock is halal. So I just explained that stock is an partial ownership. Let's say there are 2 or 3 business partners and they are starting a business. And when they do business, someone has, let's say 70%, someone might have 15%, and the rest is 15% to 3 or 4 Here, the number of owners could be in thousands or millions. And instead of having private equity and ownership among a few partners, we are having it in an exchange, so that we have a mechanism of doing that. So whenever you buy, for example, one share of Apple, you become a part owner of Apple, even if it is a tiny portion. And you sharing the company's profits, whatever Apple will make, at the end of the day, they give you some kind of dividends to its owners. You get some dividends, which is the cash benefit. And if there's a business risk come, if the company grows, its business grows, it will have more market value, the business will worth more. Obviously, it will generate more revenues and more profits, and portion of it will come to you eventually based on your percentage of ownership. On the downside, you also bear the risk if the business struggles. And if there are companies who have been struggling for decades, and eventually even some were shut down, and people lost their money, that's the business risk. So you need to understand where to put your money at the right time. The problem with the stock is that many people start gambling on it, and then they put a lot of chunk of money to artificially increase the price of the stocks, and then take the profits. And the small investors, people like you and me, individuals, they got trapped in this entire thing. They don't know exactly when to enter and when to exit, and how to understand what the big guys are doing. Who are those big guys? Funds managers, banks, big investors, and they have a lot of money to move the market and move a particular stock, and this is what they do all the time. And can you present cheers for them? Cheers for those. So you need to understand where the flow of money is and flow of investment is, and this is not easy. This is not easy. It takes years and it takes a lot of experience, and this is where you need some kind of mentors. And people have a tendency, they think they start making money in a stock is very easy. Now the stock market plays with your psychology. People at the other end of the table, market movers and market, they are very smart people. They have spent their lives in it. So they know how the individuals and the small players are working, when they are in a hype mode, so when to take money out, when to pull the rug. They know all sort of tactics. And they play tactics with you and us, and we need to understand exactly what is going on. So they play with what are the basic needs. A lot of money is moving around. So greed. For example, when a stock is moving up and up and everyone is after, oh, it's moving up, it's greedy. So people become greedy. And then psychologically is also very important, that some people share the success stories with others. They want some things and they want others to be on the same boat. On the other hand, you won't find many failure stories, because those are terrible. No one would like to portray himself or herself as a loser, as a losing person. That's why you don't get many losing kind of stories now and then. And then obviously then there's a hype is created. And that's why it attracts you and pulls you. So towards whatever is shining, and not everything which shine is gold. Okay, we all know that. So it's very hard and difficult to control your greed, especially when the market is going up and up and up. So how the stock market works, I already touched it a bit. There are two main exchanges, New York Stock Exchange and NASDAQ. New York Stock Exchange normally have the companies which are kind of blue chips, stable companies. They've been here for maybe 100 years plus, even more, and they have solid but slow growing businesses. NASDAQ, on the other hand, they have more like tech-oriented or high-growth companies. So the tendency of the high-growth businesses that they move fast in anticipation of future, good future value and good future revenues and fundamental. And they also drop like that as well. Whenever there are bad news come, the entire trading gets disturbed, and people don't know what to do. So there is a lot of a kind of a volatility when it comes to NASDAQ compared to New York Stock Exchange. We all know that about the ticker symbols. It's a very basic thing. There are short codes like Apple has APL, Microsoft has MSFT, Tesla has TSLA. For central hours, we have 8:30 to 3 p.m. Monday to, but there are pre-market as well as post-market hours where people do trade. And it is possible to have trades during those times, but the liquidity or the volume of the shares traded during those times are very low. So not advisable for us, small investors and small traders, to do pre-market or post-market trading, because big guys normally they always work during these open market hours where the most of the volume is there. So let's have a comparison between stocks and some other investment and asset classes. So the asset equities, long term, they have a high growth potential. Permissible, halal mode, permissible if it is screened. So every stock, there are thousands of stocks, and correspondingly ETFs, exchange traded funds, which focus on one group of stocks only. Now we have to screen them whether they fit and pass our criteria or not. Real estate, the growth potential is moderate to high, but we should be careful to avoid interest-based loans. Now we're talking from our Islamic point of view. Gold, silver, we all know they are hedged against inflation and basically kind of a halal store of value. It's just not gold and silver. We have copper and we have other commodities as well. Savings account, growth potential is very low. In US, we hardly get any return on savings accounts. At one time, it's been even less than 1%. Now maybe we will never take a look at those. Why? Because those are mostly interest-based. So we should avoid those. Bonds, they are all interest-based. US Treasury funds, the conventional, the growth potential is also low. It consists of riba, and we should avoid those. Now here comes the tricky part, options and futures. Their growth potential is very high, they are very speculative. But halal loans, they are questionable, high gharar, in other words, a lot of speculation, a lot of gambling involved, and I do not recommend anyone to do these things, especially options. And so that guy who came to me just last week and having an argument with me on futures and options, he was an option trader. And his friends were telling him that it's not halal. And he wanted me to say something to make it halal for him. And I had gone through all these things. I've done options trading, futures trading, so I know inside and outside. Option is simply betting in future on an asset. You never own that asset. At least you never intend to own the asset. That's the basic difference. He said that then why day trading is halal? I said that as long as the instrument is halal, the stock is halal, it's just like I buy something right now, and at the end of the day I sell it to somebody at some profit or loss. If it is halal and it is under my ownership, then the trade is also halal. So we had an argument. Ultimately I said, look, I am not the right person. You go and ask scholars. Just do a Google search. Ask it, Google. And you will find that 90% plus scholars will have objections on options. And the 10%, they might have if and this and but, this kind of thing. So if there are so many question marks, why get involved in this? Ultimately, we have to be responsible for whatever we make. So in my theory, personally, I don't do these things options, and I don't recommend this thing. And future as well, there are some question marks. Some scholars say halal, some scholars say haram, but even then it's in futures. We're betting about a future thing, which is a price which will occur at a certain point of time. The power of compounding plays an important role. Now, average investment return in US markets has been around 8%, starting from 1950s. But for last 5 years, it has been 16% and more. So very lucrative when you compare to any other mode of investment. So if $200 per month you just save from your income, let's say if you earn maybe $6,000, so 200 is around how much? 200 upon 6 is by 2 by 6 is 33%, 3.3% I think. Yep. So if you say 3 or 5% of your income per month, put that in some good stocks. which from your knowledge, from the mentors or the guys who you're following, they let you know that these are safe stocks, these are halal stocks, long term, have good potential. Then after 10 years, through the compounding system, it will be 36,833. But after 20, it will be more than $100,000, and after 30, it will be 290. The problem is that we cannot wait for 10, 20, and 30 years, and let's be realistic about it. So we have both modes available, long term as well as short terms. Now, for the young investor traders, starting at the age of 25 instead of 35, it nearly triples your final wealth. The cost of waiting is enormous. So I have met many young investors and traders, and I was surprised how much they got involved into the last two items, options and futures, instead of stocks. Because stocks doesn't give you returns immediately. In options and futures, you can make money within seconds, within a day, within a few hours, and you can lose the money the same way. And again, they have made it very easy to trade options and futures. Anyone with $70 or $100 can start doing that. But you cannot make a lot of money with $70 or $100 in stocks. It's completely different. You need a good amount of money to make a good amount of return as well. But the options and futures, now they are prop firms, and now they are highly leveraged instruments, and they let you start playing with very minor and small amounts. So that's why the young investors, they get into those trapped, and then they again, like that gentleman, try to prove it so that it's somewhat, in some way it is halal. Unfortunately, it is not. Shaitan has made it easy for us, or more attractive, in other words, to get into those things. And the halal thing is long term, need more patience, tolerance, and experience. It's difficult to get. So we just discussed this thing, I think. So what we are going to again focus, that permissible is that you should have its ownership. It's in your name, and it should be a productive business. So those are the companies where we focus. Companies in halal industries like technology, healthcare, consumer goods, low debt to asset ratios. There are many small companies, especially startups like SpaceX. Those are hot. Everyone is talking about SpaceX. There's IPOs coming, but they have a very high level of debt. And according to the Islamic financial standards, beyond a certain point of debt, you have to pay a high amount of interest. So we have to take care of that aspect as well. Whether it's highly financed, you will find the company who have 50% of their equity is financed, 50% is equity, actual money put by the owners, and they don't have clear and transparent operations. So we should be focused on that. They should have clear and transparent operation. What should we avoid? Conventional banks. Almost all banks are interest-based. Insurance. Almost all scholars tell that insurance is not halal. So we don't look into insurance companies. Alcohol, gambling, casinos, tobacco, most entertainment companies, because they crosses the lines, pork-related businesses, and as he mentioned, excessive debt or speculation. One hadith from Tirmizi 2417, Prophet ﷺ said, the 2 feet of the son of Adam will not move on the day of judgment until he is asked about his wealth, how he earned it and how he spent it. And that's a Sahih hadith. So we should be very careful how we earn our money. Don't get into those traps put forth by Shaitan. Quick money and quick return. And we forget about the end when we will be held responsible for those. So let's simplify this thing. We have a standard known as AAOIFI. This means Accounting and Auditing Organization of Islamic Financial Institutes. It's an organization. They have created this standard, and I think they are UAE based in Dubai based, and they have a board of Sharia scholars, and that particular standard is available online, so you can download and you can understand. And it basically uses two filters. One is the business activity, as I mentioned, the core business must be from halal, and 95% of revenue should come or more from the permissible sources, and less than 5% should be from. For example, you have a hotel chain, or with a small bar, or you might have a Costco, but they also sell alcohol. So it needs time to go into the depth of how much of their earnings is coming from alcohol business. Financial ratio filters, they have three different financial filters. Interest-bearing debt, it should be 30% of market cap. So for example, if a company is worth $500 billion or $10 billion, so the interest which they pay, it should be the the amount of the equity or market cap which they have financed should be less than 30% of their market cap. Income from interest-based sources should be 5% or less of their total revenue. And their liquid assets, cash plus receivables, should be less than 70% of the market cap. So these are the filters this standard has provided us, the broader guidelines. Now, there are many good halal friendly vehicles as well. On your left, those are exchange traded funds known as halal ETFs, and those are beginner friendly as well. So if you don't know much about the stocks, you can focus on these ETFs only, especially during the beginning. And they have some very good, for example, SPUS. This is a Sharia compliant Standard & Poor's fund, the S&P 500 index, which comprises of 500 big companies in US, very popular. This is a Sharia compliant version, so it takes off all insurance companies and all banks, mortgage companies, if they are there, from that particular list of 500 stocks. And there are many individual small fund management companies, like most of you know about Amana, Wahid, SP funds, there's one HLAL, and those have, because the market was good, but if you compare SPUS return versus the market return, so my observation is that most of them have beaten market returns. And the reason is some of the companies in those areas, like banks, financial, in other words, insurance, and some others, they have not really done very good business. Majority of the good return is coming these days from tech companies, and most of those tech companies are halal by nature. So if you compare the return of SPUS, HLAL, and maybe Amana Gulfront, you will find it for last 5 years much better than the traditional interest-based or the overall broader indexes. So why should we look into that? Alhamdulillah, they are better options. They're not only halal, they are giving better returns as well, and in US. On the other hand, if you want to go one step beyond that, not just the ETFs, then you can also focus on some good companies. There are big companies, Apple, Microsoft, Google, Nvidia, J&J, and so many others. And their core business and the revenue from those businesses is considered as halal. Now, compliance status can change. These are just some examples. A company, if it is halal today, it might cross that threshold, and tomorrow it might not be halal. So we need to be considerate of that in future. And there's another point. Some people say that maybe Microsoft and Google and Nvidia, they have big operations in a genocidal regime in that country. But there are laws in the US which, if you look at those laws, they do not allow to boycott certain countries, right? I don't want to mention any country's name, but you know what I'm talking about. So we have to be under those, work under those laws as well. So for example, if I have a professional service, I cannot straight away say that I boycott this company, this in this country, and no company from this country will be allowed. No, that cannot be stated. So be careful of the regulations and environment around you. Sometimes it can backfire on us. So we need to be careful on that, and then our halal definition now. Problem is that there are different platforms which give certification. And the way one platform works could be different from my way of working, and the data which is coming to one platform, for example, Zoya, Mustafa, it could be different among different data platforms. So one company might appear halal at one place, but non-compliant or haram at another place. That creates confusion. And then obviously you need to understand or dig into it and take your own decision. That okay, I understand that the core of the Apple business is iPhone, right? Or Mac, or the service business, and that's overall is haram. So I take this decision. But it has to be a cognizant decision, in other words. Many people, they are new, they are asked about how to open a brokerage account. It's very simple. You can choose the brokerage of your choice, Fidelity, Schwab, Vanguard, Robinhood. Personally, I use Interactive Brokers and E-Trade. They're all offer commission-free trading. Look for this commission-free trading. They ask for documents, and now these days, previously they were lenient, now they, I think, have a very strict requirement. They want US citizens only, and they normally are green card holders. They do not easily open of other people of other status like F1 visa or B1 or L1 visa to open brokerage accounts. Then you have to fund the account, link your bank account, and place your first trade, and that's it. It's very easy. Now what you need to look for: no account minimums, no commissions, and fractional shares available. A lot of people ask me this question, that, hey, I want to buy this share, but this is now $1,500. So I can just buy just 2 shares, 3 shares. Don't look at the 2 or 3 shares. You can even buy fractional shares, 0.2 shares, 0.3 shares. What you need to do, you need to understand that you need to take a look at your total value of investment. Let's say you have $10,000. So if you are buying maybe Sundays these days, you can buy only 5 stocks or 7 stocks, whatever. But what is your is at stake? $10,000. So look at those values, $10,000, and take advantage of those fractional shares. Not many people are aware of this thing. And choosing the right account is also it varies from person to person. Normal accounts are taxable brokerage. They are flexible, you can withdraw anytime. But if you withdraw with less than 1 year, then you come into a higher capital gain tax bracket, which is known as short-term gain. When you take the stock and keep it with yourself for more than a year, then it's long-term capital, which is 18%, so a lower tax rate. And the capital gains tax yearly. On top of that, there are some other things as well, like wash sales. That there are certain IRS rules that if you buy a stock, sell it, and within 30 days again buy it, and you have a loss in your first transaction, then you cannot claim that loss. You have to look into that aspect as well. For the individuals, there are 2 types of individual retirement accounts, IRAs. One is Roth IRA, other is traditional. And the basic difference is that in traditional IRA, the previous older one version, you can put your tax deductible, so you don't have to pay tax first and then put the money in traditional IRA. Roth IRA, you need to the other way around. You need to first pay the tax and then put the money. Now, what is the difference? Roth IRA are basically more suitable for younger generations. They have a limit, $7,000 per limit, and they are for younger generations which can keep their money for a longer period of time in that kind of IRA. Traditional IRA are basically for people like in a later stage of their lives and towards the retirement, and they don't have much time left. If working for an organization, they are offering a 401k plan, so your employer also matches your free money up to a certain limit. But the downside is that the investment menu is limited. So they have contracts with different funds, and you can only, through those fund managers, they manage your money, and you can only invest in those particular funds and there is those stocks. Now, some employer, I think most employer, they also allow you so that you take control of your money in your 401k account and do the investment yourself. So both options are available, and many people are moving from the first option for their 401k plan and trying to handle their investment themselves because they have more liberty and freedom to access their money and move it around rather than giving a portion of their return to some fund manager over whom you don't have any kind of control. So the halal, another note is to avoid the default money market fund in IRAs, because money market funds almost always they are interest bearing. They are interest bearing fund. Choose halal fund instead. A list I gave to you over here. If you have an option to choose the funds yourself. Now let's say you're trying to build your first portfolio. So first thing you need to learn to diversify so that you don't put everything in one stock. Now I get this question too often. The people say that we have $50,000, $100,000, how much I should invest in one stock? I would say that a mix of 8 to 15 quality stock names or a halal ETF reduces risk. In other words, no single stock should be more than 10% of your portfolio in any case. I am more conservative investor in myself, so I even don't go beyond 5 to 7%. At a max, it's 10%. In other words, you should have your investment in 10 different stocks. And with thousands of different stocks out there, it's not very difficult to find 10 good stocks. In other words, rebalance yearly. Now this is for the long-term investors and traders, not for short-term kind of traders. So once a year, trim winners and add to laggards to keep your target allocation. For beginners, if you're just starting, look for 70% of your investment towards ETF, halal ETF, and 30% so that your risk is reduced. 70% is being managed by experienced fund managers. And you can manage the rest of the 30% quality individual quality. For the beginners, once you have enough experience, then you can try 100% yourself. No harm in it, but you need to first learn the rules of the game. Now, risk management is something that everyone should very carefully evaluate. Now, number one, never invest money you need soon. So you should have some kind of money as emergency funds. But financial advisors normally they tell us that to keep 3 to 6 months of expenses aside. Stock money should be money you won't touch for 5+ years. Be ready for that. Another one is to cut losses early. I have seen people who become my customers or come to me, they say that I bought this stock 3 years ago and now I was 90% down. What should I do? So you have already lost. Out of $100,000, $90,000 are gone down the drain. And then you are asking me to help you recover from those $10,000, those $90,000. So what is the expected return? 900% return, right? So who can give you this 900% return advice? If I can give you this advice, then why not I make this money myself? 900% return. Simple. So don't let these things happen to you. And why is this thing happening to you? Because of hope. Losses are part of the game. Nothing is in your control, my control, anyone's control. This is market. Market decides the value and the worth of a stock. Simple. Now, losses will come to you eventually. Our job as a good risk manager is to control that risk. My personal recommendation is never allow a stock beyond 8 to 10% range. Never allow. I don't allow it in my own portfolio. Only there could be some good exceptions. If you have a good understanding of the stock's behavior, its price action, the market, and you have a conviction in its products and businesses from the past history, and its analyst rating that it will come back. History tells us, for example, gold is always on a rising trend, right? If it's a gold fund, it's gold, you can take some risk beyond, because we know that we can wait for it. We have few years on our hands, so we can do that. Small losses are recoverable, large losses are devastating, not only financially but emotionally or psychologically. Yes. They will decrease your energy, they will hamper your way of thinking, and you generally will try to take that money back from the market, which is not a good strategy. Avoid borrowing to invest. Margin and interest-based loans are dangerous. Invest only what you own. So the problem with options and futures, they are almost always leverage, and they are margin-based. So do not go into that kind of thing, because once you have something on loan, you have to pay interest, number one. So why pay interest to somebody else, especially when we have this halal and haram criteria to us, in front of us all the time. Now, long-term versus short-term trading. So long-term is known as investing. For the beginners, it's always recommended long-term. Many people come to me and they ask me that we just starting, we don't know anything about the market, what should we do? And the first thing I should do is think long-term. Think about something that you are going to keep with you for 1, 2, 3, 5 and 10 years. Don't go for things which you know after 5 or 10 days you don't know what is going to happen with them. So hold for years, not days. Buy quality and ignore daily noise. You will always find daily noise. That someone has tweeted this thing, something is crazy is happening over there in Middle East, something is happening in between China and Taiwan and this and that. My personal experience is this, that most of these news items and hypes in stock markets are created for some purpose. When they come down, settle down, things will go back to the same thing. So don't go after that noise. That will keep your stress level lower and also the tax level as low as well. And the time plus patience will result eventually in compounding. Now the active trading is not for beginners, it's for experienced people. It requires skill and time. Buy and sell within maybe weeks, months and days. Require deep technical skills, understanding the chart reading skills which are not going to be acquired, it cannot be acquired within a few days or weeks. Not possible. You have to invest your time. It's something like people do PhD and they invest how many years? 5 years, 10 years of life? Then they get that degree. So now on the stock market, the irony is that people want to quickly start making money, and once or twice when they are successful, they think that we have become successful and we have become masters of this thing. Unfortunately, this is where you start going down. Market is very smart. It will place you in front of you in the mirror, and then you say, it was me, I made this decision. It's so hasty, out of the emotions. So this is where most beginners lose. They lose money trying day and swing trading. It's only for experienced people. Now, I give this signal to people, I have those customers who do, but I always first tell them that this is not, if you are new, it's not for you. You need to have some experience in that. If you don't have experience, do some simulated trading first. On simulation, on papers, understand the strategy, and then only try it. Now, how to pick the right stocks? Let me see if this clicker is working now. Problem. Yes. Give me a second. Okay. Surprisingly, this light is not coming on television. Okay. So how to pick the right stocks? Before you buy, there are 4 filters to apply. Actually, there are 5th one, but that's a sub-filter. Number 1, there should be strong fundamentals. I'm talking about buy and hold a long-term strategy. It should have revenues growing, earnings growing and positive cash flow. Only these two things, first two things, top line and bottom line, growing revenues and growing earnings. These are the keys. If a company is continuously increasing its revenues, growing its earnings, ultimately this stock will pick up. The investors and the traders out there will realize that this company has been profitable, doing good business, and every year and every quarter is increasing it. And if some people are ignoring it, broader market, then some smart investor will start jumping into it. And this is where our job is, that we should always go to take a look at the fundamental parts of it. Not just we see the chart and start moving and then we jump into the action. Another thing is to identify a leader in a leading group. This is another mistake which many people do. They see something going up, maybe from this point to this point, they say, hey, stock is going. Should we buy it? I almost see, I think 10 of this kind of queries every day. And I have to put a stop. I tell them over and over again that is it a leader in a leading group? So number one is the group. Every company is working in some industry or some group. Let's say a group has 50 companies. What overall that group is doing as a whole? So we have ETFs which are tracking that group. We have indexes which are tracking that tech sector is a big group. We have subgroup within tech sector, like semiconductors, like software, like renewable energy. Those are all set. Now it is possible the tech sector as a whole is doing very well, but the group inside that sector is not doing very well. For example, renewable energy was a beaten down group for a long time, maybe 2 years, 3 years. Companies like First Solar, Solar Edge, Sunrun, these companies. And people were saying that every now and then, oh, should we just jump into buying this? Thing is that the entire group is weak, and when the group is weak, there will always be pressure on its components. If the group is strong, then even the weaker companies will get some kind of buoyancy, support. The weaker company. Now, our job is to first identify what are the leading groups, and then among those groups, what are those leaders. This is where you can get the best return, best out of best. Instead of getting trapped, number one, in a weaker group, and sometimes within a weaker group, some companies do very well. This is possible. And then within that group, we are stuck with it's come down, it's at the bottom, it should go up. That's the tendency. But things do not work like that. For example, Bank of America, a big bank. In 2008 and 9 financial crisis, Bank of America was $100, $70, I think, before the crash. It started coming down, 60. People said, hey, it's come down to $60, very cheap. Some people started buying it. Then it came down to 50. More people got motivated. But the Bank of America kept on falling and falling. You know where did it stop? Anybody remember that? 2008? Sorry? 2008? You buy it, but eventually where did it stop? This is what my question is. $2. So think of those people who bought it at 60, 50, 30, 20, 10, in anticipation of hopes that it has come down. So the group was extremely weak, and it was not a leader within the group. It was almost the most beaten down, although it was a big bank. So eventually it had to bounce back. So this happens. So we should not get trapped into that. Institutional support, now this is another aspect we should look. Big funds are actively buying. We are not big fishes, we are individuals. Now there are measures and ways of measuring that is a stock getting support by big fund managers or being banked investors. And if they are buying it under the table, maybe the stock is coming down and down, fine. But if they are buying it and broader market and you don't know it, it means that it will eventually find support. And that's how we should find a good stocks. Okay, it has come down, but we need to understand where the big money is flowing. Third thing is that it's coming out of basis. So the way we work, we take these three filters, and then, okay, fine. A stock has strong fundamentals, pass. It's a leader in a leading group, pass. It has good broader institutional support, pass. But we cannot just buy it like here. That's not the way at least we work. Where should we work? We should identify the basis and the buy point. And we should only buy when it is coming out of that base. For example, on this chart, I don't have unfortunately the clicker working on this TV. So this was the buy point when it's coming out of this thing. You see when it comes out of this buy point, it gave a big rise. This was the buy point, next buy point, again a big rise. This is where we should be. Now, this comes with experience, how the bases are formed, how the buy points are created, where should we cut our losses, what should be our target. This comes with experience. So this is not something which can be learned overnight. The other way of doing this, that we buy on pullbacks to strong support. Now, again, is it stock still a leader in a leading group? Yes. First we have to check that. Is it still finding its support by a big institution? Yes or no? If it is finding, then ultimately it will stop at a good support. So in this case, this is finding a good stop. So it was just consolidating or taking a breath for a while, and then we find when it came down, they found support here. There's a pullback to a rising moving average, which was acting as a strong support. Again, this thing will come with some kind of experience, not for the beginners. But when the concept will get clear to you, because there are so many traders and investors who will be waiting at these buy points, just not you and me and others, who will be waiting at these bases, buy points and the pullback support line, and they will jump into the bandwagon at that particular time. Provided these things, these filters, these conditions are met, only then we will go for that. Otherwise, these buy points and these support line pullback, they will also fail. Everything can fail, you know that. But there are higher chances of success if a stock passes through these filters and then it comes down to this buy point or break out of a base. And our job as good traders and investors to look for those points rather than jumping into and chasing a stock at the high point. That's not something that we should do. Because eventually everything that goes up will come down. So if we are chasing here, it will come down here one day, fine. What is our reward to risk? How much we are risking? Is our risk is from here to here or here to here or here to here? And how much is our reward? So if the reward to risk is not 3:1, your risk level, for example, here this buy point, here is this. The reward level should be at least 3 times or more. Then you should take this kind of trade. Otherwise, forget it. Now, if you have become more experienced and you're doing it more often, you can even live with a smaller reward to risk, maybe 2:1. But I normally do not prefer, when I recommend to others, anything less than 3:1. To me, it's not worth it. You have a limited amount of capital and money to put it to the best of the best choices. So for example, this is from our own software. So this was which Micron, last 1 year. So we have this buy point identified by the system. This is buy point, this is stop loss. When it comes across this buy point, this is the time to buy. When this buy point, this is the time to buy, but this is stop loss. Here, it never approached this buy point. Why? Because we were not in a strong zone. It was forming a base. So we kept on waiting and waiting and waiting. Fine. until we got this green zone between the base has been formed. Go back to the previous slide. You see the breaking out of a base, but there were other checks as well. Was it a leader? Yes. Was it finding institutional support? Yes. So it was just waiting. Previously it did the same thing. So we have this buy point, stop loss, and not necessarily every buy point and stop loss will work. But eventually, since we are in a leading group, eventually it worked. And when it worked, it probably gave us what kind of trade? We entered something around 130 and we closed it at something around 370. That's more than, in a few months, $300 or $400 on single stock. So this is the kind of things we should try to target. Strong stock leader, leading group, fund supporting, institutional support, good revenue and growth. What is so special about Micron? It has a very good product and it has a earning growth this quarter is 250% from the previous quarters. So market cannot ignore these things. Eventually market will follow that thing. And now the gamblers and investors and all sort of people will be after it, they will keep pushing and pushing. Now is not the time to buy. Because your reward to risk is diminishing. Where is your risk and where is your reward? People ignore this aspect. So these are the common beginner mistakes. Beginners normally they start chasing tips from social media or family. Hey, this one is hard. Go and just get this thing. Or someone was telling me that this stock will go. But what about those filters? Earning growth, revenue growth, big guys growth. What about this? Is it a leader? Is it a leading group? People don't really go into the depth of those things. Similarly, sometimes when there is a selling at the bottom, when there's some scary news comes around, how are you doing on time?
You can continue the topic, but we have to leave at 7:40. But you can continue.
It's almost 7:40 now.
Yeah, we have to leave in a few minutes, but you can continue.
Sure.
And just the mic that I will go.
Okay, no problem. Thank you. So panic selling at the bottom when news turns scary. Checking the portfolio 10 times a day. If you are long term, then you think long term. Do not check after every hour or 2 hours. FOMO, fears of moving out or left out. FOMO, buying after a stock has already run up 50%. You think that it's at 50%, but I will be left out. So you start chasing it. There is no plan buying random stock without a strategy. What I discussed here was a strategy, this thing. And having a defined buy point, stop loss, and defined reward to risk. That's a strategy, that's a plan. But people don't buy with these things. They go after something. Putting all saving into one sure thing stock. Someone told you that this stock is going to do wonders, and you put all your savings in there, and ultimately, one day you have to wrap up your account or do something else. And this last item is also very critical. No sell rules or exit strategies. It's easy to get into a stock. Very easy. You go do some clicks and you will own that stock. But when to sell it and exit or cut your, that's one of the most difficult things. And not many people are expert when it comes to this thing. They get confused, either they get out too early or they just keep on waiting, or they are under some hopes. They eventually things will get better. If I can share one of I probably was caught by one stock by this. It was going up and up every day. I said, okay, why not try with some small amount? I put some small amount because I knew that there was a risk was very high. Guess what? Next day it started coming down. Very next day, which probably was just waiting for me. And after even a year or so, it's still 90% down. So I said, okay, this was one of the best stock, and I was just so I have put that thing inside. Whenever I come into this thing, I take a look at that stock because it's there for me to learn a lesson, and it is still in my portfolio. I'm still hoping It's not a big amount, so it doesn't matter to me. But that's a big lesson that if you start following these things, then this will happen to you. Every mistake here costs you money. Recognize them and walk the other way. Habits of successful investors. Those were the habits of beginners, common people. The successful investors, they are patient. They know wealth compounds over decades, not weeks. They are always learning. It's an ongoing journey. Read, watch, ask questions, stay curious. They are plan driven. They are not randomly driven by some news or someone giving them a tip. Have clear rules for buying and selling. They are disciplined. They stick to the plan when others panic. They know the good times will come and go, bad times will come and go. And they are grateful. See wealth as a means, not an end. And they are community minded. They give zakah, supports family and ummah and other things. This is also very important. What goes around will come back to you. Comes around. And normally many people think that we'll just do it individually. Actually, it's better to have a team of people who can support each other, share ideas, learn from each other. I think that's pretty much it. So we're towards the close of the presentation. This is our website. We have a YouTube channel, our email. If you want to connect with me and have future questions, you're welcome to do that. We have our flyers also. And I think we should now open it for the questions here as well. So any questions? From sister side, from men's side, any question? No questions? Everyone knows everything? Yes, sir.
Sorry, it came late. So what services do you provide?
What services? You have a flyer in front of you? Yeah. So we have a software. Here. The software, we have a proprietary indicator system which gives you strong buy and sell areas with the recommended buy and stop losses, buy point stop losses. And then complementary to the software, we have different type of services for long-term traders, because mostly my focus is on long-term. But there is a heavy demand for the short-term traders for all around, so we also give them signals for the day trading as well and swing traders as well.
You say you also provide signals to day traders?
Correct. But we always specify that it's not for everyone. If you have an experience with day trading, you know how it works, there is a list. Now what's going to happen, only Allah knows. Be careful to take this. Personally, the software itself and the services that we have is more like learning and education type. So we do not take other people's money and invest it on their behalf. That's not our domain. It's more like a learning and education platform and a software to access. And as I said, we give signals to people. Swing traders almost one or two swing trade every day. I'm sorry?
What is the cost for that software? So if somebody has an account already.
You have an account with me?
No, I'm just saying if somebody already has an account like E-Trade or something like that, so how you people work with that?
No. It's not working with any brokerage account. It's independent. It's for your learning and analysis.
How much is the cost for that?
It depends. You have a monthly plan as well, starting from $10 per month, just a weekly, $25 per month. If you buy that for a whole year, it's going to be discounted $275 a year. It's very reasonable, not very much.
So stocks that you select for the day trade, are they halal stock? Because when I go and check those stocks on Zoya or Mustafa, so most of the time they fail. So on one app sometimes it says halal, but on the other it says not halal. Sometimes it is failed because of the financial. So I believe in US, every stock will be failing.
Did you come a bit late? I discussed this thing, Zoya Mustafa, earlier on.
Yeah,
I said that it will always happen, and there's a reason for that. We have an app, we have programmed our standard according to standard. Zoya Mustafa have different analysts, and they have their own data pipeline. We have our own. There is always a difference between data. So what we focus is that we focus more on the broader versus strict definition. means that we understand that there will not find any bank insurance and these companies over there. Further to that, further going to the depth of it, we will take a look at the debt level, interest if there is any. But beyond that, if you want to go further into further depth, like Masjid Al-Mustafa have those kind of resources. They take out each and every quarter reports of the analyst. This is what they do, and then go into the segments of the business. And each segment they identify how much the revenue would come from. And most of the time, it is not clear from those reports. So it is possible from one analyst to pick up a report and come up with one recommendation, and it is possible for another analyst to pick up the same report with come with a different, because his understanding will be different from first person understanding. So there will always be issues around that. Nothing is perfect. My suggestion would be that you keep it in the broader term. That, for example, something is an insurance company. Out simple. You keep it in a. You know that a major chunk of the business is defense related and selling arms to one particular country, which is against Muslim Imam whatsoever. Simply take it out. So that's how we work.
So basically like IT, energy, gas.
Mostly in tech stocks.
Yeah.
If you want, because they have more day trading ranges. But personally, again, I discourage day trading. I have mentioned a number of times. I am a long-term trader myself, and I discourage it. I think the stock market should not be taken as a gambling instrument. It should be taken as a long-term wealth generator. Yes, sir.
What are the views on the leap option?
Say again. Can you speak up?
Leap options.
Leap options.
Are those halal?
I think leap options are options, right?
Yes.
I had a long discussion on options, I think, before you came in. In my personal opinion, options are not halal. Now, most of the scholars as well, what I have made the research, I found more than 90% of the same opinion. Because options involve what? A betting that a certain thing will value this much at this point of time in future. This is what option is. And at that time, if it happens, then I will get that in shares or stock or whatever. Leap option is a bit different, I know that, but it's, at the end of the day, it's still an option. Okay?
What would you suggest regarding safe investment in stock? I believe I heard regarding
ETFs?
mutual funds.
Yeah, I had a list of, I don't know whether you have seen it or not, list of halal funds, and I strongly recommend if you are a beginner, you start with those. Here it is. Halal ETFs, beginners. These are all halal funds, halal ETFs, and available here in the US. And I strongly recommend that if you are a beginner, then you should focus on these first. Otherwise, try 70-30 split. 70% of investment to this area, 30% to individual stocks. You had a question?
Yeah. Okay. My question is, today we have this seminar, and we're gonna go home. How much money we need to put in if we wanna start investing, and how, because you say it's long term, right? When you say long term, what's gonna be your advice? Because obviously the chart you show me, I don't understand anything about it. So I don't know how we're gonna use your services for me to be able to invest. When should I invest? When should I'm gonna do practical steps.
It depends.
Baby step from
I understand, but it depends upon each person's individual case. How much time you have and how much money you have. Compared to this brother, how much time and money he has. He might have a job from home, but you might have a job in the field or at office. So you don't have time, even 1 hour during that time, but he could spend maybe 2-3 hours. Number one. Number two, even if you are a long term, I'm talking about our services, so you can take our weekly newsletter or weekly services, and that will take you 30 minutes in a week time to have a plan for the next week. Now, how much money? Again, it's very personal financial advice. I don't know how much savings you have, how much savings he has, or someone else has. I cannot advise you on that. But I can only advise in a broader term that invest only those funds which, if are lost, they do not change your overall financial conditions. So you start struggling.
Okay, I'm going to give you a practical example. I used to have a little bit of retirement money from my teacher retirement account. And the account was not making any money. And I Googled it, they said, okay, you can move it to Fidelity. So I moved the money and I bought a halal stock. But after 6 months, it was losing money. So I moved everything back to my retirement account.
And who was managing it? Fidelity?
Yeah, I bought from Fidelity. I those stocks. I Googled it and I bought one of them. It was losing money after 6 months. I said, what's going on?
That's bad timing.
Look, there are two things. One is bad timing. You have to develop certain skills yourself as well. After all, it's your money. That is it good time to be in the market, or is it time to reduce your exposure? That's one. Everyone has to learn something. Second thing is that those Fidelity guys, they're professionals, I understand. But it's hard for them to make an exit if things are falling. Because they do not have just you, they might have hundreds, thousands of accounts. So they cannot sell all those accounts, all those, and go back next day. As an individual, you can do, I can do. So there are certain things, trade-offs. So that's why their overall percentage return will be balanced and close to the overall market return. Now I mentioned this thing that these SPUs and halal funds, they performed over the last 5-6 years much better than the broader market funds like SPY and Triple Q. They did perform better than that in their respective area. So
Yeah, how about cryptocurrency investment?
how about the crypto?
Oh, yeah.
Very difficult question actually. Because they're highly speculative in nature.
Yes.
Now, I know a group of Muslim investors who are having a conference in Dallas. I think they had it last month. On having Muslim investors how to invest in Bitcoin. And obviously they have their back end covered. They have some fatwas and my suggestion would be to keep only to 1 or 2 top strong which have high market value crypto funds only, because there are thousands out there and most of them are scams or they're not good performers. If you limit yourself, again think long term. You are not there to just trade today, tomorrow, think a bit long term. So for that matter, I would stay with some mainstream crypto funds. Bitcoin and Ethereum, for example, not beyond that. I know people have invested everything in Dogecoins and this coin and that coin. My problem is that I don't understand that if they're worth something, what exactly is they are made up of? Why they were worth $1 billion or $5 billion? Are there some assets, financial assets on the ground? Or they are just on the speculation that you have some certain crypto, so he will buy it at a higher price, and he has an anticipation that he will buy on some higher price, and he thinks that he will buy it. If that is driving this entire chain, then something is wrong to me. I want some assets behind everything. For example, in case of IBM, I know what is IBM's business is. What are their products? What is their history? What are their assets? What are their liabilities? In terms of an XYZ crypto coin, I don't have that information. So that makes it very difficult for us to make a long-term decision. It could be very for short term. All right. Any other question? Yes, sir.